I hope you have not forgotten everything previously we discussed. So now we are on the different topic that is to recap the things we discussed, I think then from objective financial management. Management, maximize it. Shareholders, share of owners, of creating value. So that is value. So the topic is fiscal return. So when it comes to the fiscal return, how it connects this to our main objective. So you remember the value we calculate, face value of money we discussed, bond valuation, security value we discussed. So value basically equal based on the cash flow. Value can calculate using the model like this. Value is based on the cash flow. So expected cash flow we discount using discount factor. Right? Using discount factor. So this is we call discount factor. This discount factor in the time value of money we define as the discount factor. In our next lecture, cost of capital, we define this as a company minimum required rate of return from the investment. In the security valuation, if you remember, we define this as the investor's required rate of return. So this discount factor is same as the investor's required rate of return. When it's come to the investor's required rate of return, I think you remember I explained this one at the introduction also, is equal risk-free rate of return plus risk-free. Is equal risk-free rate of return plus some risk premium. So this risk-free rate of return, risk-free, right? Risk-free means no risk, no risk. So that is risk-free rate of return. So basically we identify risk-free rate of return based on the government security. Government security. Because you know that government securities, when we say the government securities, you can remember treasury bills, treasury bonds. Okay? They are the government securities. So these government securities are issued by who? Government. So they are fundamentally free from default risk. Since they are issued by government, not a person, not an institution. So therefore, that is we identify theoretically as the risk-free investments are the government securities. So based on the treasury bill yield, treasury bond yield, so we can identify this risk-free rate of return. So this risk-free rate of return for time value. If there is no risk, only default risk, right? Only the credit risk. But other risks are there. There can be what we call market risk, exchange rate risk, political risk, country risk. So all other risk factors are affecting, but only the default risk or the credit risk. What is default risk? Credit risk same. What is default risk? What is default risk is the possibility of not having the cash flow. That is the default risk. There is no default for the treasury bonds. Treasury bills because they are issued by the government. Government default. So therefore, no default. So it is free. Right. So then, if there is no default risk, it's risk-free rate of return for what? For the time value. For the time value of your investment. Then we add some risk premium. We add some risk premium. So risk premium for what? For bearing risk of this particular investment. Bearing particular risk. Now suppose you can invest. What are the possible investments you have? Now suppose you have some money. So what are the possible investments? You can invest in fixed deposit. You can invest in treasury bills. You can invest in the stock market. You can invest in the corporate bonds. So like this, there are different investments. You can invest. These different investments are having different degrees of risk. Yes. Now, if you take these treasury bills, they are risk free. There's no default risk. If you invest in the stock market, listed companies, ordinary shares, compared to the corporate bond investment, you can save out the risk. This is high. Because they are the residual owners, you will be the owner of this particular company, so you will be a residual owner. So in case of the bankrupt, if this company went bankrupt, bondholders will get their money before you. That is the theory. Before you, corporate bondholders, bank loan providers, they will get the money before you. So ultimately you will get something. It remains. If there is something. So likewise, you will be a high risk taker compared to the bonds. So if you invest in the fixed deposit, compared to the bond investment, this is no risk. And if you invest fixed deposit, your expected returns are very certain. Certain degree, you can predict you will have this much of interest. So therefore, that is certain compared to the corporate investment, less risk. So likewise, different assets are having different degrees of risk. So therefore, this risk premium is different. If you invested in the stock market, your risk premium should be 1 lot because you are taking high risk. So in order to compensate for the investor, you should have a large risk premium. Your required rate of return fundamentally is equal risk-free rate of return, that is the premium for the time value, plus risk premium for bearing risk. If I elaborate this one further, this risk-free rate of return includes two components, that is real rate of return and expected inflation. Inflation risk-free rate of return includes real rate of return means without any inflation plus expected inflation. So therefore, when we say the risk-free rate of return, it includes expected inflation. Right. So my story is this risk return, this is our today's topic, how it connected to our objective. How it connected to our objective. Now you can see the relationship. This is a rate of return. Discount factor. Company cost of capital. So fundamentally, it will be consist with this relationship. Higher the risk, higher the required rate of return. Lower the risk, lower the required rate of return. Higher the risk, higher the risk factor. Higher the risk factor, lower the value. This discount factor and the value inversely related. Inversely related. They are inversely related. So when this factor is increasing, it implies that high risk. High risk. So higher the risk, uncertainty is high. So then the value is declining. So value is affecting. So likewise, there is a trade-off between risk and return. There is a trade-off between risk and return. So this is our ultimate objective. We are trying to maximize this value as much as possible. This is our aim. This is our objective. So then when you are maximizing this one, this is affecting. This is affecting. There is a trend drop because these two variables are inversely related, not the positive. So there is a trend drop. So as a finance manager, you should be able to manage this properly. If you remember first lecture, I can remember under the shareholder wealth maximization objective, there was a slide saying characteristics or the attributes of shareholder wealth maximization. You can see one bullet is there, avoid high level of risk. If there is a slide with you, you can see. It avoid high degrees or the high level of risk. That is the meaning. High level of risk means high uncertainty about this expected cash flow. So higher the uncertainty about this expected cash flow, higher the risk premium here. Higher the risk premium here, this bigger rate of return is higher. It is going down. So then it will affect the company cost of capital, company value. Investors require rate of return, intrinsic value. So ultimately it's affecting value. So there is a trade-off between this risk and return. So today we are going to discuss this risk return trade. Right? So this is how this risk return trade-off, this topic is connecting to our objective. In this discussion, we based on only the discussion is based on only the ordinary shares. You can discuss this risk return trade-off for any type of securities here. Right? But our discussion, this risk return trade-off we discussed based on only the equity investment, ordinary shares. So ultimately, at the end of this, probably today, you will learn what is return. You will learn what is risk, how to calculate return, how to calculate risk. So then you will realize investing only in one asset or investing stand-alone way is not appropriate. You have to construct portfolio. Investing in the portfolio is the best thing to avoid the risk, maximize the return. So then you will learn how to determine the portfolio expected return, how to determine the portfolios. Ultimately, at the end, you will realize this risk premium is applicable only to systematic risk. When we say the risk, total risk, it consists with unsystematic risk and systematic risk. Unsystematic risk, you can totally diversify it away by constructing well-diversified portfolio. But this systematic risk, nobody can diversify it. Even you have well-diversified portfolio, still systematic risk is there. So you are provided risk premium for bearing this systematic risk. So that is, you will realize at the end. When we reach to the end with the capital asset pricing model, you will realize what is this systematic risk, unsystematic risk. I will explain this CAPM model also related to the systematic risk very briefly. So this is like a story. At the beginning, you might feel that is very boring. But anyway, when you are reaching to the diversification, effect, systematic risk, portfolio construction, you may realize the story. So therefore, these are the things that we are going to discuss under this. So then let's go to the and read this slide. Actually, I explained this one. What is the thing? Just read this. Risk and return are two fundamental concepts in finance. Higher returns generally considered good. Yes, we feel like this. Normally, when we are getting high interest, we are very happy. Eh? We are very happy. Yeah, we are getting large amount of interest, large amount of dividends. But risk and return go in tandem. Higher return implied high risk. That is the problem. Now, you know that there was a time with the Sakti that period. Right? People went for with the Sakti invested all they have with the high interest. When the normal financial institution, when they pay the 10% interest, they pay double, triple. So all the people went there and they invest. Ultimately, what happened? Do you remember that story? Okay? So the high return implies high risk. So because this risk and return going with the tender, they are inversely related. Sorry, not the inverse. Higher the risk, higher the return. Lower the risk, lower the return. They are positively, tender means they are going together. So that is positively related. Higher the underlying risk of an investment, it is expected return would be higher. Thus, investors of financial assets are willing to have trade-off between risk and return. Investors invest more, so there is a trade-off between risk and return. So investors invest in portfolios of different assets, different stocks. So understanding how return and risk could be measured for individual as well as portfolios is important. Rather than investing total you have in one particular investment, you may construct portfolio. Portfolio is a collection of investment. So that is we call portfolio. You may invest part of your money in the stock market, treasury bill, maybe in the real assets, bonds, or likewise you may construct the portfolio. So by constructing a portfolio, you can diversify this and you can maximize return. So that is the ultimate end point of this lecture. So you will identify what is this diversification effect. It is happening with the correlation coefficient between the returns of the assets of the portfolio. Calculate the value of security as the present value of the cash flow stream provided to the investor, discounted at required rate of return appropriate for the risk involved. So that is what I explained. So you calculate value, discounting, discount factor. So this discount factor is reflected. It is the appropriate required rate of return for that particular risk level. So higher the risk, required rate of return is higher the discount factor. Recognize that risk must be considered in determining value and making investment decisions. So this is brief introduction. So then we are going to let's have, so you have to define the variables first. So what is return? Can anyone explain me difference between return and profit? මට මතක් කරන්න එදාගේ මේ ක්විස් එක මේ මිස් වෙයි අපි 230 නේ දාලා තියෙන්නේ 233 නේ. What is the difference between return and profit? So here it is return, profit. So simply what is the difference? Return and profit. Return, profit. Are they same? No. What is the difference? Return is profit. What is the difference? Just yes. Want to understand here? Yes. Are they same? This return profit. So you have calculated profit in the income statement. The profit is not coming from the investment. Now, companies also treat the investment. So they are calculating their revenue expenditures and they are calculating profits also from the investment. Yeah. One difference I am expecting. When you are calculating profit, you include some non-cash items like depreciation, bad debt provisions. So they are not the cash outflow, they are non-cash items. But when we say the return, that is purely cash. That is the return. Profit includes some non-cash item, but when we say the return of significant pratilabh, return is the cash flow. So if you invested in the bonds, your return are coupon and the redemption value. If you invested in the stock market listed company, your return dividends might add capital gain. So likewise, it is purely cash flow. Then when we say the profit, it is different from the return because profit you calculate based on the accounting concepts and based on the accounting fundamentals, accounting concept. So profit, when you are identifying the revenue, I think you remember when you are preparing the income statement, revenue you identify not the point where the cash flow is received. That is at the transaction is occurred. Yeah, point the transaction is executed, not the point where cash flow really received the contract. So therefore, profit is not a cash item. It includes some non-cash item like depreciation. So matter is not the profit. Here, our discussion is based on the return. So return received on an investment, as you mentioned, that is reflects the cash flow. Again, I will mention that our discussion here based on the ordinary share investment, equity share investment. The cash flow received on an investment, any change in market price usually expressed as a percentage of the beginning market price of the investment. So if you invested in a ordinary share, so your return you can calculate, you can express your return using this formula. Right? So return you can express as a rupee return or as a fraction or as a percentage rate of return. So likewise, different formats are there to present the return. But anyway, mostly acceptable way is presenting return as a percentage. That is the most applicable, appropriate as well as acceptable way. If you go to the bank and if you ask bank manager what is the interest rate today, he's not telling that. He's not telling like this. He's telling 16%, 6%. So likewise, as a percentage, the return is expressed. So return you can calculate using this formula here. Dividend, it is the cash dividend. Suppose you invested for a particular period. Because if you invested in the equity share, there is for the equity, ordinary share. Is there any maturity? Then maturity? No, there's no maturity. But you are investing for a particular period. You have your investment horizon, your investment period. So if you invested for the 6 months, so DT is the cash dividend at the end of your investment period. So PT represent here stock price at the time period T minus 1 mean that is the price of the stock, the time T minus 1. So that is actually the previous price. This is actually the current price. That is the mean. So simply you can write this like this way also. Dividend plus T1 minus T0 divided by T0 also. T1 is the current or the today's price. Then T0 is the cost. If you invested at 100 rupees, so that is the cost. P0 is the cost, P1 is the current price. So that way also you can hedge. So this formula fundamentally you can use to estimate return on the stock market ordinary share investment. This is you can calculate based on the past data, historical data as well as forecasted data. Both we are going to discuss. Using past price information, dividend information, you can estimate your return. That is average return. And also based on the forecasted return with the probabilities, you can estimate return. So that is we call expected return. In this formula, then you know that this return includes two components. One is dividend yield, other one is capital gain yield. Since you are investing for a particular time period, you can realize capital gain. So when we say the return here, it includes dividend yield and the capital gain yield. So this is dividend yield. P1 minus P0 divided by P0. This is the capital gain yield. The dividend per share, DIP or dividend per share, divided by P0 cost is equal to the dividend yield. So total of the dividend yield plus the capital gain yield being called as your holding period return. Your holding period return. If you are invested for the 6 months, so your holding period return, you can calculate your dividend income, dividend yield plus capital gain. That is using this form. So this is further you can simplify in this way also. Make up with a maybe further. Right. If you have any question, you can ask. Now look at this example. Yes. Sama purchased 250 common shares, Lion PLC, at this price, 180 rupees each. Company paid dividend 3 rupees per share during the holding period. Sama sold all the shares at the total value of 5,000 rupees after 190 days. So calculate Sama's holding period return. So I forget to tell this one. So normally we present this as a percentage. So your answer you have to multiply by 100 to put it as a percentage. Normally we rate of return present as a percentage. So therefore, final answer better to express as a percentage. It's the holding period return. Here. Calculate the dividend yield, capital gain or capital loss there, capital gain yield or loss. So then calculate the holding period return. So holding period return is equal dividend yield, dividend per share divided by 0, P0 plus capital gain yield is equal P1 and price minus cost or the previous price divided by P0. So these are the capital gain and the dividend yield. So here, during the holding period, 190 days, someone has received 3 rupees as the dividend. So therefore, 3 rupees per share. Sama purchased 250 common shares at 180 each. So then this is the P0, cost of the investment. P0, 180. Eh? So then this is the cost, 180. So this is the dividend yield. Separately, if you want to identify this, so this is the dividend yield. We divide by cost of the investment, P0. Then capital, is there any capital gain? Sama sold all the shares for 50,000 rupees. 50,000 rupees. 250 common shares at 180. So all the shares he has sold for 50,000. So how much the selling price per share? 200. Eh? So P1 in this case, so then P1 is, you can calculate P1. P1 is not given. This is 200 because 50,000 she has sold all at 50,000, 250 shares. So 50,000 divided by 250, it is the selling price per share, 200. So then there is a capital gain. So that is, you can calculate 200 minus 180 divided by 180. So this total you have to multiply by 100 to put as a percentage. So what is the answer? Sixteen. 12.78. So you get 12.78. Suppose alternatively, you have another investment to invest, say fixed deposit. This is stock market investment in the Lion PLC. Alternatively, you can invest in the fixed deposit at an annual interest rate of 19%. At an annual interest rate of 19% or 19% per annum. What is your choice? 19% fixed deposit to the stock market investment. It's 10. Which one? Stock market investment. Why? Tell me, don't worry. No, any problem may. Yes, correct. That is the reason. Now you cannot compare this 12.78 with this 19% rate of return. Because normally you know that banks, commercial banks, central bank, normally they express their rate of return as a rate of return per annum. Per annum. That is the practice. Right? So this is per annum 19%. But this is for your holding period 12.78. These are in the different base. So therefore you cannot compare. So what you have to do if you want to compare this to investment, this holding period return, you have to annualize. You have to annualize it. So you can annualize this holding period return. How? You can annualize this holding period return simply dividing holding period return by holding days and multiplying it by 365. Taking 365 as days further here. So holding period return here 12.8. So 12.8 for 100. How many days? 190 days. This is for 190 days. So then you have to multiply it by 36. Oh, half of the formula. So now we have already calculated holding period return now. So then simply you can divide it by holding days and multiply it by 365. So then it will give you the annualized rate of return for the investment by applying this formula. This is holding period return. Divide it by holding days and multiply it by 365. So how much the annualized rate of return? Here. 22.24.6. Now this you can compare with the 19% fixed deposit rate of return. Right? So if you invested in the fixed deposit per annum, you get 19%. Compared to the stock market investment, this is less risky. Right? So therefore, its rate of return is 19%. If you invested in the Lion PLC, it is rate of return expected or the average base, it is 24.6 because it is risky compared to the fixed deposit. So then high risk implied with this 24.6%. Now these two you can compare. If you are a risk taker, you can go with the Lion PLC. If you are a risk avoid person, if you are not like to take much risk, you can be a fixed deposit investor. So now I explained different concepts: return, holding period return, annualized rate of return. Okay. Do or not? දැන් ඒ රජිය පාර group එකේ 3-4 දෙනෙක්ව කෝල් කරන්න යනවා. මේ පෙරේද දිනුවා. I will share with that paper very easy. And then they here. Right. So this one. No, this will take up the right. Okay. Now related to this return, another concept I have to explain, that is arithmetic average return and the geometric average return. This is from the statistics. Most of the things in this topic we import from the statistics. Risk also we calculate using standard deviation, correlation, coefficient, covariance. So we have to use this thing. Here is arithmetic average return versus geometric average return. You know that what is arithmetic average return? So that is normal average. So normally arithmetic average return you can calculate using this formula. If you have past 10 years return information, get the total dividing by 10, that is the average. Okay, that is the average. That is we call R bar or arithmetic average return. This is geometric mean, or we call geometric average return. So geometric average return you can calculate. Look at the formula. 1 plus R1. R1 means if you have past 10 years information, return information, R1 can be followed the return. 1 plus R1 into 1 plus R2, 1 plus R6, so likewise up to 1 plus Rn. Square root of n, not the normal square root. If you have 10 years observation, so then square root of 10. From the answer, you have to deduct. So then you will get the arithmetic, geometric average return. So now you can see the difference of these two statistic calculation. When we calculate this geometric, not geometric, normal average return, each observation here we consider equally weighted. Equally weighted. And also in the financial management, there is a very strong assumption that is being called reinvestment assumption. What is the reinvestment assumption? So whatever the return you are receiving today, suppose you are investing for the 10 years. The 10 years investment. So in the early period, you are getting some return. 10 years investment over early first year, you will get some return. So this return, you are reinvesting in the same investment at the same return. That is assumption we call reinvestment assumption. So that is very strong assumption when we calculate NPV, IRR, payback period, profitability index. This reinvestment assumption is very important in the investment. So when we calculate this arithmetic average return, no, this reinvestment assumption is implied because each year observation we consider independently. We get the total we divide by n. So each observations are having equally weighted, plus divide by n. But if you look at this one, geometric mean, here 1 plus R1 into, there is a multiplication. Here plus, this plus, this plus, this plus, so likewise this is plus. This impact is plus. Impact independently we are totally there. But here 1 plus R1 into 1 plus R2 into 1 plus R3. May impact may return they gave impact and here. So likewise, when we calculate this geometric mean, it implies there is the compounded value or the reinvestment calculation. So therefore, what I want to mention here, when we calculate in reinvestment, when we calculate in holding period return, now you know what is holding period return. The accurate estimation of the holding period return you will get through the geometric mean. If you calculate this average return for the holding period, it will be an overestimation. This is wrong. It not provide the correct value. The correct estimation for the holding period you can get through the geometric mean. I will explain with the example. I think there is example. Now look at this example. So you can see 3 years informations are there from the report with some past years, 17, 18, 19. Holding years, 3 years. Prices are given. price information are given. So you are asking to calculate average return, holding period return, geometric average return using this information. Now here, look at this is price, not the return. The price return. So if you know the price and the dividends for a particular period, so you can generate the return using that formula, holding period return formula. But here you are having only the prices, closing price information, no any dividends information are provided. Suppose there is no any dividends, only the price differences you have to consider. So you have to calculate geometric mean, arithmetic average mean, and the holding period. So if you calculate holding period return here, holding period here 3 years. Holding period 3 years. 2017 to 2019 holding period is 3 years. So you are starting at 100, you have ended with the 100. You have started your investment with the 100. You have ended with also 100. So if you calculate your holding period return using the price differences, your holding period return, no any dividends, no any dividend is equal P1 minus P0 divided by P0. This formula is P0. So then your holding period return is equal P1 P0. P0 100, P1 100. So 100 minus 100 divided by 100 is equal 0. Your holding period return is 0. Now you have to calculate geometric mean and arithmetic average return to understand this concept. So let's calculate together. Now in order to calculate geometric and arithmetic average return, so what you have to do, here you have to calculate return. So these are prices, no? Maintain the prices, not the return. So now you have to calculate return for these years. So return you can calculate only considering the prices because no any dividends are given. Suppose no dividends. Dividends given at dividends given make formula so you can apply this formula. This one. Okay. So make it use because there are no return, no dividends. Dividends stand. So you can use only the this. Right. So then to calculate the return for 2017, so what is the formula? P1 minus P0 divided by P0 into 100. No information for the P0. You are not given the price information for 2016. In a method return, you cannot calculate return for here. Cannot calculate return for 2017. Agree? Hindi maragate. Udi maraga. Iti ne kala is like the meaning. So you cannot calculate return for the 2017. So 2018 you can calculate. P1 is 200. P0 previous year price 100 divided by 100 into 100. Here is 2018 return here is this is P1, this is P0. Previous year P0, this is P1. So P1 minus P0 divided by P0 using that formula. So then you will get the return for 2018 50%. This is 100%. Oh, this is 100. This is 100. 2019. Help me. Two 2019, 50%. So that is 100, 100 minus 200 divided by 100. So that is 50%. Okay. So returns are there. Returns are there. Now calculate the average and the geometric mean. Calculate average and geometric mean. So return here, no return. This is 100%. This minus 50. Yeah, it's actually used to minus the minus 3. And now calculate average and the geometric mean. The average return you can calculate R bar. R bar is equal 100 plus minus 50 divided by 2. Even though you have 3 years price information, you are calculated return only for the 2 years. Right. So that is divided by 2. So this is the average return R bar. So then calculate geometric mean. RE is equal 1 plus R1. So that is 1 plus 1 into 1 plus R2 So that is 1 plus minus 50. So that is plus minus 50. It is 50%. So then this is 0.5. No? 0.5. 1 plus minus 50 is 0.5. Square root of 2. Right? Square root of 2. Even though you have 3 years price information, it is calculated only 2. So 1 plus 1, this is 2 into 0.5. So this is equal to 1. May answer from the answer, you have to deduct 1. So then square root of 1 is equal to 1. 1 minus 1, answer is 0. Okay, 0. You are getting the 0 here. This is the geometric mean. If you have any question, ask. So I'm going to prove you. That is, I'm trying. Holding period return correctly estimate with the geometric mean, not with the arithmetic average return. So what is the answer here? 25%, no? This is 25%. This is 25%. You will get the geometric mean 0. If you get this answer, this is as 0. I think. Yeah, this one. If any question, please ask. 0. අද ගණන් මේකේ තව එහාට ගණන්මයි තියෙන්නේ. මේ පටන් ගන්නවා විතරයි ගන්න. 1 plus R1 ඇයි 100%? 100% කියන්නේ එකයි 1 plus 1. එකයි 1 plus 1 කියන්නේ this is 100% නෙමෙයි. ඒක percentage එක. So then it is 1. අතන minus 50%. එතකොට 1 plus minus 0.5. එතකොට 0.5. හරි? 1 plus minus 0.5. Answer is 0.5. ගන්න. Geometric mean. So this is the formula. This is the formula. So these are the returns we calculated based on this price information. Are you okay with this 150? So 1 plus R1, 1 plus 100%. This is 100%. This is percentage. 100% means 1. 1 plus 1. This is minus 50%. 1 plus minus 0.5. That is then 1 minus 0.5. Okay. So what is the conclusion? I did all these things to tell this one. Now, if you look at this holding period, so you can see you are starting with 100. You have ended with 100. If you calculate your holding period return, 100 minus 100 divided by 100 should be 0. But look at the ARPA, arithmetic average return. It says 25%. That is more. It's an overestimation. Because when you calculate in the arithmetic average return, each observation we consider independent and equally weighted. So this 50% we consider as an independent number, not considering as a holistic period of the investment. So as a result, you are getting overestimation with the arithmetic average return. But if you look at the geometric mean, your answer is 0. So that is correctly saying your holding period return. So what is the conclusion? Therefore, it is not the simple average. The geometric mean is the return for the holding period. So if you want to calculate holding period return for a particular investment, you cannot do that with the simple average, arithmetic average return. So you can correctly estimate holding period return with the geometric mean. The geometric mean better reflects the growth rate over multiple periods because it implied our reinvestment assumption. In our formula, 1 plus R1 into multiplication. 1 plus R2 into. Here, 10 plus minus 50. Impact no impact. They are independent. So then the geometric mean correctly reflects return over multiple periods. So your conclusion is holding period return correctly reflects with the geometric mean, not the simple mean. That is the conclusion. Now let's move to the next concept. Please, before that, do this example by yourself. It's calculation. You can do yourself from your tutorial, I think. Nalin bought 500 common shares at Alupok PSC for 75.50 cents rupees each 5 months ago. Current price of the share is 80.25 rupees. He received dividend to 50 rupees per share for the investment today. How much is annualized rate of return from this transaction? Now you can do. Quickly calculate and tell me the answer. Results. Dividend 250. This is P0. Currently P1. This is P1. So there is annualized rate of return. So you are asking to calculate annualized rate of return. So then you can calculate 250 plus minus 25. Sorry, 0.25 minus 75.50 divide by 75.50 into divide by holding days 3 months ago. So approximately using now 3 months is given. So then sorry, 5 months. So then you can calculate dividing by 5, multiplying by 12 also, or you can take 30 days per month as well. If you take the 30 days, then it is 150 divided by 150 into 360. So answer, the final answer you have to multiply by 100 to put it as a percentage. Is the answer. Is it? 23. You can check your others. That is, I think, now you can manage. So the next concept is risk. So we discussed return and the calculation of the return. So the next concept is risk. So what is the risk? So simply, risk is the variability of return. Very simple way, risk is the variability of return. So now if you look at these scenarios, variability of returns are those are expected. You are investing expecting something, but actually you are getting higher than the expected or lower than the expected. Both way it can be happen. Expect කරපු ප්‍රමාණයට වැඩි කරාම වෙනවනේ මේක risk එකක්. Expect කරවට අඩු කරාම වෙනවනේ මේක දෙපැත්තටම variability එක තියෙන්න පුළුවන්. Right. So now if you look at this one, if you buy 1 year TB, treasury bills, with a yield of 22%, and if you hold it for full year, you will realize government guaranteed 22% return. So not more, not less. That is why we call risk-free. If you buy the common stock of the company and hold it for 1 year, the expected cash dividend you anticipate receiving may or may not materialize as expected. You expect some dividend. If the existing economic conditions were there, you may expect certain dividend. But if the economy went worse, it can be declined. Economy went boost, you will have more than expected. So likewise, you may materialize. You may not materialize as expected. So that is the risk. Yeah, price of the stock might be lower than expected, maybe even less than you started. So actual return on this investment may differ substantially from your expected return. So that is what we call risk. So how to measure risk? Again, we are using statistic properties, standard deviation, variance, covariance, coefficient of variation. So we have to use this way. Now look at this is the stock market return behavior. This is all share price index. I think you all know what is it. What is it? stock market indicator, all share price index return. So you can see the movement of this all share price index over 20 October 2018 to 22 like period. So you can see the variability. So this is market return. This is market return because this all share price index reflect the market portfolio. We are coming with the captain this market portfolio, so you should know that this is our market portfolio. Our country, we have only one stock market, so this is our market portfolio. This indicates all the sectors in our economy. When the all share price index is going up for a particular period, it indicates holistically economical, economic going up, economic development situation. When the all share price index is going down, it indicates holistic downturn. So likewise, this is our market portfolio. So then you can see the market returns behavior for a particular period. So if there's a risk, it affects with the systematic risk factors, unsystematic risk factors. So likewise, certain factors are affected. So it is variable. Right. So if you look at this diagram, this is previous one is the market portfolio, market return. Now this is the stock return for two stocks A and B. You can see the distribution of return for these two securities A and B. This is expected return. Expected return for both A and B same. Right? Return, just forget about the expected part. Return for both 15%. So this is the deviation or variability of B and A. Which one is risky? They gave a return සමානයි 15%. The return එක අපි ඉගෙන ගත්තා. return එක 115. දැන් මේ තියෙන්නේ මේ expected return එක variable වෙන හරාසෙ. අපගමනේ standard deviation. So this is for the green line for the stock A, red one for stock B. Which one for this? A or B? A or B? B. We can say A. We can red line it. B then. Who can be the B capital, this is the return average or the expected return for the day. And this is the possible deviation of this expected return. एक method तैयार करो. වැඩි වෙන්න පුළුවන්. වෙන method तैयार sorry method එක අඩු වෙන්න පුළුවන්. method තැනක වැඩි වෙන්න පුළුවන්. මෙයා උඩට තමයි යන්නේ. This is very more peak. The distribution is more peak. And the green one, it is very wide. Yeah, ගොඩක් විසි වෙනවා. Expected return එක එයා spread out වෙනවා. මේ ඈතට යනවා. ඉතින් මෙයාගේ මේ 50% වෙන මේ හරියට අඩු වීමේ සම්භාවිතාවයකුත් තියෙනවා. මෙච්චර දුරට වැඩි වීමේ සම්භාවිතාවයකුත් තියෙනවා. එයා wide. අර උඩට නෙමෙයි යන්නේ. එයා මෙහෙම spread out පල්ලෙහාට wide ව ගමන් කරනවා. ඒතර කාගේද risk එක වැඩි? Aද Bද? A. දැන් මෙයා මේ expected return එක ගොඩක් ළඟින් මේ උඩට යන්නේ. මෙයා මේ expected return එක සමයවන්න. ඒ කියන්නේ that is very close to the return. නමුත් මෙයා ගත්තොත් මේ return එකට very far away. ඈතයි. ඒතකොට එයාගේ deviation එක තමයි. ඒතකොට in these two diagrams, two distributions, A is because it's very wide. Distribution is very wide. This one is more peak. Yeah, distribution. So by looking at the distribution, you can identify this. Same thing by calculating standard deviation, you can quantify. So what is the risk? Risk is the variability of return. The අපි return එක calculate කරා. අපි හිතුවා මෙච්චර dividend sum වෙනවා මෙච්චර capital return. So this expected one අපි හිතමු මේක expected අපි calculate කරේ කියලා. මේක වෙනස් වෙන්න පුළුවන්. So that possible deviation is the risk. So that is you can calculate using statistic tools like statistics. So I think you have learned them early. Okay? So yeah, just taking from the statistics and we interpret the risk. We are taking this for the decision making. So risk is the volatility or variability of returns from the average or the expected return. Risk of historical returns could be measured. This is based on the past data or the historical data. Next one we discuss based on the expected one. So variability or the volatility of average return we can calculate simply variance, standard deviation, coefficient of variation. So you can see sigma square variance we indicate using this symbol sigma square. This is sigma. This is coefficient CV use karadama. What is the difference between variance and standard deviation? So normally square root of the variance always is the standard deviation. Square root of the variance is the standard deviation. So if you look at this formula, I think I believe this is not the first time we are seeing a formula like this, right? So you can see this is the deviation of the particular return from average, square of the deviation. If you have 10 years observation, so you have to take all this deviation and their square. So then totally you have to divide by n minus 1. So here we divide this by n minus 1 because this is from the past historical sample. In order to minimize the sampling errors or the sample biasness, normally statistics we divide it by n minus 1. So once you get the square root of this variance, that is we call standard deviation. Both variance and standard deviation you can use to measure the risk. Higher the variance, higher the risk. Higher the standard deviation, higher the risk. But remember, in financial management, rather than the variance, normally we are using standard deviation to interpret the risk. Because the reason is this variance we standardize using standard deviation. Because square root of the variance is the standard deviation. The variance, when you calculate the variance for the particular distribution, it can be a value. It is value. Say 60, 55, 365. So likewise, it can be any number. But once you standardize the variance, normally for the stock return, variance always is the percentage. So interpretation of the standard deviation is easy than the interpretation of the variance. So therefore, in financial management, more frequently, we are using standard deviation to interpret, to identify the risk. But anyway, you have to calculate variance because square root of the variance is the standard deviation. Coefficient of variation, that is very simple thing. This is also you can use to measure the risk. Suppose now you are going to invest in the three different companies. Three different companies in the listed in the stock market. Three different companies. So you want to identify the risky company. So then you have to calculate coefficient of variation to identify that. So what is the coefficient of variation? It shows you risk per unit of return. Coefficient of variation gives you risk per unit of return. Look at the formula. Coefficient of variation you can calculate standard deviation divided by average return. Standard deviation divided by average return. So suppose coefficient of variation say 1.2. So what it means? Risk per unit of return. එක ප්‍රතිලාභය එක විදියට මෙච්චර risk එකක් තියෙනවා. ඒ කියන්නේ රුපියල මෙච්චර deviate වෙන්න පුළුවන්. මෙච්චරකින් අඩු වෙන්න පුළුවන්. So coefficient of variations provide you risk per unit of return. So by calculating coefficient of variation, you can compare different stocks to identify less risky, low risky or high risky companies by calculating this. This is provide risk per unit of return. I think it is there for explanation. Later, I think it is there. So these are basically we are using to measure the risk. The question. No need to break it. Do you need the break? Today, actually, I need to stop around. Today, schedule at 6 o'clock. I'll stop around 5:15 line because I have to go to the loss. So then we reduce the break. At 5:30 miles. And I continue on the 3. No, not the 3. I will give the break at 2:50. While at 2:30, please again. You can have a break for 15 minutes. You can count the minutes. If you need to refresh, you can go and come. But other or if you need to come the change, you can stand and sit. Right. So you can calculate variation and standard deviation and coefficient of variation. So let's calculate now. We have our exercise. I told you that there are so many calculations. So this is based on the historical data. So you are providing full series of annual returns for stock P and Q. Annual return. Here PQ 12% annual return. This 12% includes what? Provided annual return based on past data 12%. This includes what? How this 12% comes? How this 12% comes? Then the annual return is serial over there. The return calculate kata. This 12% includes capital gain and dividend gain. Considering dividend and the capital gain, so this 12% has calculated. So you are provided annual return, calculated annualized return. So what you have to do, determine arithmetic average return, variance, standard deviation, coefficient of variation for the above information, and indicate which one is risky, which stock is more risky, which one is less risky. Don't take much time, so you can apply that formula and you can calculate. Formula function. What Paul selling code? Do you have any question? Right. That's it. Let's go with the stock fee. Calculate the average first. Calculate the average. Alpha or average, you can calculate 12 plus 14 plus 17 plus minus 6 plus 15 divide by 5. Alpha sorry, 10.4. So now calculate the variance. Don't worry about the formula, you will follow the process. But writing here variance variance of P is equal to average return minus annual return minus average return. After deviation, I will show you the formula. Return minus average. After deviation, so we have 10 years, 5 years. So get the whole sigma total divide by n minus 1. That's all. So let's calculate the variance. Variance is equal 12 minus 10.4. Graph is deviation plus next 14 minus 10.4 above it plus, I'm writing here 17 minus 10.4 plus minus 6 minus average 10.4 10.4 deviation. So then you may get the total, this total summation with the total. So that total you have to divide by n minus 1. N minus 1 means 1, 2, 3, 4, 5 here. 5 minus 1, that is 4. And then total is it. We are 5 n minus 1. So that is 4 divided by 4. Total or divide by n minus 1. Or total is it? 300? 340.
49.2.
Yes, 349.2. Correct. So that is divide by n minus 1. We have 5 years annual return. So n minus 1 means divide by 4. So it is you have to divide by 4. So that is the variance. 349 deviations වල වර්ගමන එකතුව. So rate එක අපි බෙදන්න ඕන. මේ කටපාඩම් කරන්න එපා මේ formulas. මේක ඒ total එක අපි බෙදන්න ඕන n minus 1 වල. Okay? N minus 1. So then you will get variance how much? And variance. Variance top P 73.87.3. 87.3. So then once you get the standard deviation of this, square root of that is the standard deviation 9.3. So same way you can calculate variance standard deviation for the stock Q. So these are the answers. I'm not taking time here. Later you can do. This is the average, variance, standard deviation. Now calculate coefficient of variation. Coefficient of variation, risk per unit of return, standard deviation divided by average return. Standard deviation divided by average return. Of variation. 39, 1.19. Right. These are the answers: variance, standard deviation, average return, coefficient of variation. Which is risky? P or Q? Now you can look at the numbers. Which one is risky? This is the standard deviation of P. This is the standard deviation stock P. This is the standard deviation stock Q. This is the coefficient of variation for the P and Q. Which one is risky? If you are going to select, if you are going to invest in the low risk security, what you are going to select? P or Q? P. Based on the standard deviation, also it shows it is low, but there is a problem, right? You cannot take this decision by looking at the standard deviation. You have to take decision based on this coefficient of variation. The reason for that, there is a different average return here. Average returns are different. The main average return you can take the decision by looking at the standard deviation also. But here, average returns are different. So therefore, you cannot select stocks by looking at the standard deviation. So this deviation for this average return. This deviation for this much of average return. So therefore, you cannot compare. So you have to look at this coefficient of variation. If you are a risk taker, if you are going to invest in the risky one, you may select this. Any questions, any clarifications on this calculation? Any elaborations if you require? Since the coefficient of stock Q greater than the P, stock Q is than the P. So when it's come to this standard deviation, you need this one to take the decision. You know how to calculate that. So when it's come to the stock return, as you learn statistics, the stock return is a continuous distribution. So therefore, the stock returns you can interpret using the properties of normal distribution. This part actually not take much seriously, but anyway, I will explain how to apply the stock return for the decision making, the standard deviations and the average return for the decision making, because you should know. Simply this part I will explain. Since the stock return is continuous variable, so therefore you can define this stock return also using a normal distribution properties like this. So you know that this is the normal distribution. In this distribution, you can say, if you take some estimation from this distribution, you have confidence. You have 68.26% confidence that your number within one standard deviation. That is the meaning of 68.26 confidence is there. If you calculate, if you estimate some number with this population, so that number within one standard deviation, one standard, this is average, within average, within a standard deviation. Within one standard deviation, the confidence is 68.2. Deviation you can forecast by 95.46 confidence level your number within two standard deviation. Now, statistically, good use 95% confidence level. අපි estimate කරනකොට hypothesis test කරනකොට significant analysis කරනකොට අපි ගන්න 0.46 confidence level. ඒ වගේම 99% confidence එකකින් ඔයාලට කියන්න පුළුවන් මේ number එක within 3 standard deviation එන්න පුළුවන් කියලා if the stock returns are normally distributed. If there is a bell-shaped distribution like this. So therefore, by expressing the difference from the expected return in terms of the standard deviation, we are able to determine probability that actual return will be greater than or less than any amount. So, as an investor, if you want to know the probability of getting zero return, using this average and standard deviation, you can identify that probability. I am just explaining this one. I am not testing this one for the exam, right? But we all agree knowledge is made to get them. Normal distribution take a stock return distribute as an investor. If you want to identify probability of getting zero return, if you invest, then average return standard deviation. So with these two properties, you should be able to determine probability that the actual return will be greater than this much or less than this much. So that you can do. How? Now, in this case, this is different example. This is average. Don't need to calculate based on this numerator. This is average. This is standard deviation. Data form you can calculate. So therefore, if you put this into this normal distribution, you can tell in the statistics term like this. You can tell you have 46 confident. Our estimate of the return from the historical data range from this range. How much make it? 95.46 confidence can within 2 standard deviation. Within 2 standard deviation. Then after make calculation after distribution this is the standard deviation 11.16. This is the average. This is the average. So then you can tell that 2 standard deviation can make 1 standard deviation. Maybe standard deviation dekak tula estimation එක තියෙනවා. ඒක තමයි කියන්නේ. Either 2 standard deviation can make a they can so they can get 22.32. They can 22.32. 22.32. එතකොට මේ average එක ඒ කියන්නේ අපි average එක තුල just එක 3.17 can increase by up to 24.49. How this 24.49 come? 3.17 plus 22.3. Average 22.32 plus. And also from this end, make up that our actual return can decrease up to minus 19.15. 3.17 minus 22.3. So that way you can interpret. If you know the standard deviation and the average with this different confidence level, you can interpret. Further, actually this I have not included. Further, if you want to know based on this distribution, suppose as an investor, you want to know probability of getting zero return. Then make it a distribution properties. So as an investor, you want to know the probability of getting return zero. In the statistics, you can do that. There is a statistics Z value table. Well, statistics someone ඉගෙනගෙන ඇති. අපි calculate කරන Z value එක based on this mean and our expected zero value. So you can calculate that. එතකොට ඒ value එක අර asset table එකේ තියෙන තැන අනුව ඒ probability එක කියනවා. මේක මේ විදිහට තමයි decision making වලට යන්නේ. So simply here you calculate standard deviation. Just you learn higher the standard deviation, higher the risk. But further for the decision making, you can use this now. In the set table, using the set table, you can learn the probability of getting zero return, probability of getting return more than 25%, probability of getting return more than say negative 2%. So likewise for any number, you can identify probability. I'm not explaining this part because if you are doing portfolio management and things in the higher, I think there is a portfolio, no? You can learn this. But anyway, just calculating this one is not sufficient. Make a technical matter. You can interpret like this. And also using that asset value table, you can identify probability of getting 0 return, 25% return, 30% return. You can have the probability using the probability numbers of the asset value table. Any question? Next one is the expected return. I think better to have more break. It is now 2 o'clock. Come around 2:15. अभी लेकर कहाँ थे पता नहीं लाइना वाली उसको अरेंज करना लगता है any question so are you okay with this what for you others like one expected return देने के break after break आता है then you have 10 minutes break and come okay तो मतलब कि आगे मुझे आगे की अब तो क्या कुछ नहीं है वही इसको तो नहीं ना ये वाला है इसको बैठे इतना बड़ा चावल लेके पता करो तो मैं बोल रही हूँ ऐसा नहीं है ज़्यादा बड़े क्या पता क्यों मैं आप देख रही हूँ क्या पता क्या है दैट में जो ये इसका क्या है ओके 220 का टेस्ट अरेंज करना है 220 तो विद्यालय प्रशांत की तरह आगे गवर्नमेंट ऐसा मानता है इधर काट कर ले ऐसा वाला पता कर लो coordinator. Oh, okay. Thanks. मासिक के दिन है सर्टिफिकेट भी करे ओ ओपन अवेलेबल है क्या वो कोई नहीं मेरा कंटिन्यू करो आप हम करो बहुत रेस्ट और रेस्ट थोड़ा एक्स्ट्रा डिमांड करते हैं इतने कारण है और इतने ये मान दिए हैं ना विदाड़ी पहाड़ है विदाड़ी पहाड़ है कि मामा मेरा चेहरा माटे अंदर से ट्विस्ट ले मान दिए हैं ना विदाड़ी पहाड़ में एडजस्ट कर ले आने සපල් වෙලා තියෙන්නේ අර උත්තරේ හදලා මෙයා මේකේ තියෙන මේක කිව්වම හරියට හරි. සපල් කරලා තියෙන දැන් ඔයාලා බෙදාගෙන ඔයාලා හිතන්න ඔයාලා ප්ලෑන් කරනවා කියන ඔයා පස් වෙන ප්‍රශ්නේ මම ආයෙ පිළිතුරු දෙන්න. බඩුක තමයි. So, average return based return calculation BT. So now expected return. For the investor, the expected return is the most important one because we are investing for future. We are investing for future return. So therefore, to determine the expected return, determining the expected return stock, probabilities of occurring future returns are forecasted in accordance with the possible future economic condition because we are forecasting future expectation. So here, when we calculate the expected return, we have to we have to deal with the probabilities of happening. So if these economic conditions occurred, it is the forecasted return. If the economic condition will say worst, it is the forecasted return. So likewise, all possible economic conditions and the probabilities of happening these economic conditions and the forecasted return under each economic conditions, you have to identify to estimate the expected return. But You are providing all this information based on this forecasted return. You have to calculate expected return. So formula for expected return calculation like this. Very easy actually. Expected return is equal. This is RI. RI means forecasted return. Don't miss up, right? Forecasted returns of the stock I under different economic conditions. Expected return, forecasted return. Two different meanings. So you have to forecast return if economic condition X occurred. This is your forecasted return. If economic condition Y is occurred, this is the forecasted return. So likewise, all possible economic conditions, all possible economic happenings, you have to identify. So here RI is forecasted return of the stock I in different economic conditions. So what is then Px? Probability of occurring different economic conditions. Probability of occurring different economic conditions. So if you are given forecasted return and the probabilities of each economic condition, so then you can calculate expected return for the stock, forecasted return multiplied by probability of happening that particular economic condition. So likewise, if you have three possible economic conditions, so all these three you have to consider. So that way you can calculate. So this, before going to the list, I will go to the example. Now look at this one. You are consider the following information relating to the forecasted return for stock X and Y, not the J and K, right? X and Y. So you are provided this forecasted return. Better to write here forecasted return under 4 state of economy. Possible state of economy. So if you get the total here, you can see it is equal to 1. These are the all possible probable happenings in the near future of the economy. If the state of economy 1 is occurred, this is the forecasted return for stock X. If state of economy 2 is occurred, this is the forecasted return for stock X. So likewise, if the state of economy 4 occurred, this is the forecasted return for stock. So now, based on this forecasted return and the probable probabilities, so you can calculate expected return for stock X using this formula. That formula, if I show you the formula again, don't worry about the formula. For the exam, we will provide the formula sheet. So this is the formula based on this formula. Forecasted return under each economic condition for this particular stock multiplied by the relevant probability. If you have 4 state of economy, so you have to consider what 4. So that total is the expected return. Expected return. Now in this example, our expected return you can calculate here. So expected return stock X simply is equal, right? Expected return stock X is equal Right. So now expected return we can calculate, right, for this one. So you can do expected return x is equal, this is that formula. Forecast return under the first state of economy is minus 8.5 into the probability of happening this first state of economy, that is 0.5 plus forecasted return under the state of economy 2, 7.2. The probability of happening this state of economy point plus under the third state of economy forecasted return for the stock X 6.5 into probability of third state of economy happening of that 0.5 plus the fourth state of economy occurred, forecasted return 4.2, probability of happening is 0.2. So this sum total is the expected return. That is the expected return. So this is the expected return. Stop. 8 minus 8.5 into 0.1 plus 7.2 into 0.2 plus 6.5 into 0.5 plus 4.2 into 0.2. The total is the expected return. Similarly, you can calculate the expected return for y. Expected return for y is equal the state of economy 1, forecasted return is 8.5. Probability of occurring that state of economy 0.1. Plus, if the second state of economy is occurred, forecasted return minus 5.4. Probability of occurring it 0.1. Plus, forecasted return under the third state of economy 4.3. Probability happening this is 0.4 plus forecasted return in the fourth state of economy is 7.5. Probability 0.2. So that is the expected return y. What are the answers? The expected return. I think answer for X. Expected return is 4.68. Expected return for Y 3.4. This is it. The expected return you can calculate. Like this. Using this formula. Now the next one is risk of this expected return. Now previously we discussed risk of average return. Based on the past data, if you calculate average return, risk of that. Now the risk of this expected return. So that is again we are using same statistical tools like this. Calculate the risk. So what is the risk of the expected return? So you can define it as risk of forecasted return is the possible deviation of forecasted return from the expected return. So how to define that? What is that risk? So the risk of expected return means now we have forecasted. May state of economy ඔක්කොම ඇති වෙන්නේ නැහැ නේ ඔකෙන් එකයි වෙන්නේ. Right? In the economy you will get only one. But these are possible. State of economy 1, 2, 3, 4. So likewise all are possible state of economy. So then what is the risk? Risk is possible deviation of forecasted returns from the expected return. So likewise, again variation, deviation, variability of the forecasted return. So that variability you can calculate using variance, standard deviation, coefficient of variation, and also covariance. So let's discuss this later. So again, same formula, but that's the difference. Look at the previous one and this one, see the difference. In the previous, with the average return, when you are calculating the variance, how was that formula? Divide it in -1, no? Right. Now here, this is forecasted return stock high under the state of economy 1 with deviation from the expected return, right? RIX mean forecasted return stock high under the state of economy, say X, its deviation from the expected return into probability of the square of the deviation, right? Deviation is square, our square of the deviation into probability of happening that state of economy plus next one. Forecasted return stock high under the second state of economy, its deviation from the state expected return, of the deviation into probability of happening second state of economy. So likewise, we have four status of economy. So then in the third state of economy, forecasted return stock high under the fourth state of economy, its deviation from the expected return, of the deviation into probability of happening third state of economy and the fourth. So that total is the variance. The total is the variance. So once you get the square root of that, is the standard deviation. Coefficient of variation same, no different. Only different here, standard deviation divided by expected return. Previously, standard deviation divided by average return. Previously, you calculate standard deviation divided by average return. Now, standard deviation divided by expected. So, this is based on the forecasted information. So, now we have to calculate variance, standard deviation, and coefficient of variation for these two stocks. So, in next, we are going to construct the portfolio using these two stocks also. So, now we already calculated expected return. So, now calculate variance, standard deviation, and the coefficient of variation. I will do in the back whiteboard, right? Will do. We have calculated expected return. Expected return, we have already calculated. Now calculate variance, standard deviation, and variance, standard deviation, and coefficient of variation. Expected the next course. Expected return next. What is the answer? Because here are 3.14. 4.68. 4.6. Now calculate variance. Variance of x. So you can apply that formula. You can calculate variance. The forecasted return of the stock X under the different state of economy. In the first state of economy, forecasted return minus 8.5. Minus 8.5. Deviation from the expected 4.68 multiplied by probability of happening in this state of economy, that is 0.1 plus next. In the second state of economy, forecasted return for the stock X, I'm writing like this, 7.2. Deviation from the expected, this is graph the deviation, right? This graph the deviation. 7.2 minus 4.68. Graph the deviation multiplied by the probability of happening state of economy to 0.2 plus. In the third state of economy, forecasted return stock X 6.5. Deviation from the expected 4.68. Of the deviation probability for happening state of economy 3.4 plus the third state of economy is forecasted return 4.2. Deviation from the expected return. Of the deviation, the probability happening all state of economy 0.2. So get the total here. This is the variance of X. Variance of X. Given variance of X, you can have variance standard deviation 4.67. So graph, this is the variance. What is your answer? The standard deviation. So once you get the square root of your answer, you will get this is the standard deviation. Variance here. Variance of variance the stock X 20.35. So this is the answer 20.35. So variance stock Y you will get. How the answer? Standard deviation again. The standard deviation is correct, so you can check the variance. Then variance Y also considered like. The same way you can calculate variance for the stock Y and the standard deviation for the stock Y also. These are mathematics and the statistics, so you have to practice. For the exam, you cannot manage time if you are not practicing well. Otherwise, you might think how to apply these things. So likewise, you are consuming time. So therefore, you have to practice, right? So this is the way of calculating for the stock X. So the same way you can calculate that for Y. Calculate this one, otherwise we cannot calculate coefficient of variation. Do the variance for the Y also quickly. You can calculate, you can calculate. You will the answer for this one also. And calculate coefficient of variation for X and Y also. more. Expected return expose 4.629.
Three, 3.4.
3.4.
Transfer 4.68.
4.6. And y
Extended return 3.4.
3.4. Correct. So now calculate coefficient of variation. Now you have standard deviation, expected return. So calculate x and y coefficient of variation also. This is why you make completed. What is the coefficient of variation x? So you can calculate standard deviation divided by expected return. So what is the answer?
0.9.
0.96. 0.96. Previously also we did the same thing for the average return. So why?
1.3.
1.36. 1.3. Now again you can compare these two stocks X and Y for their risk. Now you can see Y is risky because its coefficient of variation is 1.36. If you are going to invest in the low risk security, you can select X here. Again, you cannot compare with the standard deviation here also because different expected return. So you cannot take decision using standard deviation. Any questions, any clarifications up to this? Sarah? Sarah? कारण बदल पण त्याचा विभाग आहे ना बदल Order in the Lapu page, Lati page, Lati department. There are other so any question? Do you have any question? Do you have any question? So the last one is the covariance. Even covariance you can use to measure the risk. So now we discuss variance, standard deviation, coefficient of variation. So what is this covariance? Covariance also you can use to measure the risk. So normally to calculate the covariance, you need two variables. Now this variance standard deviation you can calculate for the single security, single stock. But covariance, we measure co-movements of the two stocks written. Right? Co-movements of the two stocks written. By looking at their co-movements, you can assess the risk. That is very important. Our next discussion is the portfolio. So the portfolio construction, this covariance, correlation coefficients are very, very important. Right? So to measure the covariance, we need to variable. So normally covariance can be positive, negative, or zero. Now suppose two stocks returns is moving like this. Say this is time, this is return. If two stocks are moving like this, say this is the X returns, stock X return. And if it is, this is Y, what is the covariance? Over the time, right? Over the time, X moving like this. Y also going in the same pattern. If you take the time period from here to here, both are decreasing. Both returns, both stock returns are decreasing. Might be because of the economic factor or whatever. So what is the covariance here? The movements between this, is it positive, negative, or zero? Here, covariance is positive, negative, or zero. When the X is decreasing, Y also decreasing. Now, if you look at this period, both are increasing. Covariance is positive. So, in a particular time in the economy, both stocks are moving to the same direction. Both stocks return, right? Stock returns are moving to the same direction. This is possible. Suppose these two stocks are moving like this. A, like this. When X is going like this, Y is going opposite to that one. Totally opposite, right? So if you look at this period, this is not nicely presented. This is decreasing, this is increasing. During this period, say this is X, return is decreasing, X is decreasing, Y is increasing. So the covariance is negative. Covariance is negative. I told you that there is a risk return trade-off. Higher the risk, higher the return. Lower the risk, lower the return. Now, if you look at this positive covariance, both of returns are decreasing. So returns decreasing mean both the risk also decreasing. So there is no trade-off. If you construct the portfolio using the stocks with the positive covariance, you might not get any diversification benefit. You will realize this point, right? But if you construct the portfolio using the stocks with the negative covariance, if you construct the portfolio with the negative covariance, there is the risk diversification heading. Because when the X is decreasing, it implies that its risk also decreases. When the Y is increasing, it implies that its risk is increasing. So then when you combine these two stocks as the portfolio, there is a risk return. So you can get some risk diversification at one. You can get some risk diversification at one. And also sometimes stocks can move like this. Say, when the X is moving like this over the time, Y is going like this. What is the covariance here? This is positive, this is negative. There is no sort of covariance. It is zero. Covariance is zero. Then nothing after 100 has a demand on a straight line. There is no identifiable covariance. So this is covariance zero. The covariance can be positive one, negative one, zero. In the portfolio construction, covariance as well as correlation coefficients are very important. So how this covariance is related to the risk? Because if you can construct a portfolio with a negative covariance stock, you can have diversification advantage. You can minimize risk, you can maximize return. Right? In future, we further elaborate this one with the correlation coefficient also. So what is covariance? To measure the covariance, there should be a two variable. For one variable, you cannot measure the covariance. දෙකක් තියෙනවා විචාරය. විචාරයන් දෙකක සහ හැසිරීම මේවා නෙමෙයි. That is the covariance. එක්කෙනෙක් අපි හිතමු ආර්ථිකයේ යම්කිසි සිද්ධියක් වුණා. දැන් අලුත් ආණ්ඩුවක් ආවා. ඒතර ඒ වෙලාවේ stock X එක කොහොමද හැසිරෙන්නේ? Y එක කොහොමද හැසිරෙන්නේ? So that is you can measure using covariance. That is the covariance. So you can measure the movements of the two stocks. So what is the formula? So you can see formula for the covariance is equal forecasted return stock I under the state of economy X, its deviation from its expected return multiplied by forecasted return stock Y at the same state of economy and its deviation from its expected return into probability of happening in this state of economy X. The rapid state of economy හතරක් තියෙනවා. ඉතින් අපි මේ හතරට මේක හතර පාරක් repeat කරනවා. In the first state of economy, forecasted return stock X, its deviation from its expected return into forecasted return stock Y, its deviation from its expected return into probability of happening first state of economy plus text. So likewise, for state of economies, you have that. So that number is the covariance. So let's calculate covariance. I will serve you slide. Just start using this formula. we need the expected return and the fee. Expected return is how much? Again, by the return. This example, we are continuing with the portfolio also, right? Don't forget this example. Now we are going to construct the portfolio using this X and Y stocks, right? And tell me the expected return is. It has 3.4. 4.68. Excellent. 4.68. Y. 3.4. 3.4. Expected return Y. Now we are going to calculate covariance, right? So covariance between X and Y. Covariance between X and Y stock returns is equal. I am applying that formula. In the state of economy, forecasted return stock X minus 8.5. Deviation from its expected return. How much? 4.68 into, in the same state of economy, forecasted return stock Y 8.5. 8.5 8.5 deviation from its expected return, that is 3.4 and probability of happening that state of economy 0.1. Sure. 0.1. So then plus. Next one. Then forecasted return in the second state of economy 7.2 minus 4.68. Then in the same state of economy, stock Y forecasted return minus 5.4. 0.4 is the expected return. And probability 0.2. Probability point plus. In the third state of economy, forecasted return stock X 6.5. Deviation from its expected return. Forecasted return stock Y 4.3. Deviation from its expected return 3.4. Probability 0.5. Thus, the last state of economy, status of the economy, forecasted return 4.2. Deviation from the expected 4.8. 7.5xy deviation from its central equal to probability. Okay. To get the total here, this is the covariance. Covariance between the two stocks written. Any answer? Positive. What? Minus 10 point. How about others? Minus 10.73. Minus 10.73. How to interpret this? It is negative. How we interpret it? What is the meaning that? Okay, now that is important. So this is negative. It means that X and Y variance negative. Means what? The particular time in the economy because of some event happening. So these two stocks are reacting positive, negative way. That means when the X is increasing, Y is decreasing. But the problem with this covariance is, yes, you can say they are moving to the opposite direction only. You can say they are moving to the opposite direction. But you cannot tell when the X is increasing by 1%, by how much? By 50. That is, you cannot tell. That is the problem with the covariance. By looking at the covariance, you can identify only the direction of the movement. Only the direction of the movement, but the size of the movement you cannot interpret. For that, in future, we are calculating correlation coefficient. For that, you can say when the X is increasing by 1%, Y is increasing by how much? That is, you can. Thank you. So now If you construct a portfolio, now I'm asking question, now you have certain understanding about based on this discussion. Now suppose you are going to construct a portfolio using X and Y. Rather than invest in X only, Y only, you are going to construct a portfolio. දෙකේම ආයෝජනය කරන්න යනවා. 50-50. Can you have any benefit if you invest these two stocks in a portfolio? Do you have any, can you gain any risk return benefit? Diversification benefit or the risk return trade-off benefit? Is there a possibility to get the risk and diversification advantage? You can understand that point. That is very important because now we are going to the next discussion. Now it is a negative covariance. When the X is increasing, Y is decreasing. Positive means both are increasing in a particular time, both are decreasing. එතන trade off එකක් නැහැ. risk එක වැඩි වෙනකොට දෙන්නගෙම වැඩි වෙනවා. risk එක අඩු වෙනකොට දෙන්නගෙම අඩු වෙනවා. ඒතකොට එතනදී අපිට වාසියක් ගන්න බෑ positive covariance. දැන් මෙතන negative. එකක් වැඩි වෙනකොට අනිත් එක්කින අඩු වෙනවා. So then is there a possibility to get some advantage? Yes. You have advantage. You can get. So that is what we are going to do next. But when we say the portfolio, the diversified portfolio means at least you have to invest 40, more than 30. With portfolio with the more than 30 stocks, at least to be a well diversified fund. But anyway, we discuss only the two asset portfolio to understand this concept. So our next discussion is portfolio. Up to this, any question?
Then you want to read the other. You can run it. After the keep they take a bit and the break and push game
weight එක. ඒක රවාගම ලක්ෂයක් තියෙනවා නම් 50000ක් X වල 50000ක් Y වල කියන එක 50-50. benefit එකක් කියලා. දැන් අපි හිතමු එතකොට මේ දෙකට තියෙන relation negative. I think all of you can understand Srilanka. මේ දෙකට කියන්නේ negative relation. ඒකට blast එක දෙන්න react කරන්නේ opposite එක. එක්කෙනෙක් return එක blast එකකින් අඩු වෙනවා. අනිත් එක්කෙනා වැඩි වෙනවා. ඒකනේ මේ කියන්නේ. එතකොට අර අඩු වෙන එක්කෙනාගේ risk එක අඩු වෙලා return එකත් අඩු වෙලා යනවා. වැඩි වෙන එක්කෙනාගේ risk එක වැඩි වෙලා return එක වැඩි වෙනවා. එතකොට ඒක කියන්නේ අර trade off එක. ඒ trade off එකෙන් තමයි අපේ portfolio එකේ benefit එක. ඔකට correlation coefficient එක තව ටිකක් ඉස්සරහට මේකත් එකක් දෙන්න. benefit එකක් අපිට unsystematic risk එක 0 කරන්න පුළුවන්. if you can construct a well diversified fund. I will show you with the diagram. You can see, you can reach to zero. A risk එක unsystematic risk එක බිඳුවයි. ඒකින්ද අපි කොහොමද ඇත්තටම මේ අර risk premium එක දෙන්නේ only the systematic risk. For the unsystematic case, no need to provide premium. මොකද rational investor කෙනෙක් නම් එයාට පුළුවන් වෙනවා ඒක diversify කරගන්න by constructing a well diversified portfolio. ඉස්සරහට ගිහලා ඒක කොහොමද වෙනවද? සුන්දරයිනේ. නැත්නම් දකින්නේ වෙනස. ඉස්සෙක දකින්න we are going to portfolio. Now you know that as an investor, you want to maximize return, you want to minimize risk. Normal human being always trying to maximize return, but you want to minimize risk. So now you can see these two are conflicting. Now suppose you are given two choices like this. Specialized finance, there are specialization in specialization portfolio modeling degree. That's why they expect a return standard deviation. Now you are given two stocks with attributes like this. Expected return both are 10%. The standard deviation X 12%, Y 15%. You are going to select in one. Which one you select? X or Y? Which one you select? This same expected return, so this expected return, the risk level is 2%, so that is lower. So no point of having high risk. So you may select, X. That is correct. So this is we call risk aversion. So you want to avoid the risk. That is one of the expectations. I think this bullet from the given set of investment with the identical expected return. Now here expected returns are identical. Investors demonstrate tendency to select the investment that has least level of risk. So this nature, this behavior we call risk aversion. As a human being, we always try to avoid the risk aversion. And also suppose you are given like this, X and Y, say expected return and the standard deviation. This is 12%, this is 12%, 20% and 15%. Now what you are going to select? Then this is 25. Which one you select? Here. What? When you have identical risk, if you are given the identical risk level, first bullet, from the given set of investment with the identical risk characteristics, so then you have a tendency to select the one with the highest expected return. So that is we call, you want to maximize return. You want to minimize risk. That is nature. As a human being, you always, we have one balance return maximize risk minimize. These are two objectives in the investment. But the problem is these two objectives are conflicting. Why? When you are maximizing return, according to our risk return trade-off theory, when you are maximizing return, it implies high risk. When you are minimizing risk, it implies low return. So there is a conflict between these two objectives. So therefore, in investment portfolio, in financial management, so to achieve these two objectives in a reasonable way, to achieve these both objectives in a reasonable manner, we are constructing a portfolio to maximize return at a minimum level of risk. There are a portfolio maximize return at a minimum level of risk. So that is our expectation. So therefore, we should be able to construct the portfolio with a minimum level of risk. So this major we call, this is non-satiation. If you want to maximize return, that is we call non-satiation. Again, non-satiation you always try to maximize return. This is risk aversion, avoiding risk. So we have been able to achieve the objective. So we are constructing the portfolio to achieve the both in a reasonable way. So now what is the portfolio? What is the portfolio? Collection of the collection of the different investment. I will give you a good example. Now if you have X, if you put all the X in one basket, if this basket fallen out, what would happen to the X? All are destroyed. Likewise, so if you as a person, as a rational investor, you have to put X in the different baskets. That is the portfolio. That is the portfolio. So you invest part of your wealth in the treasury bills, part of your wealth in the stock market, part of your wealth in the real estate, bond. So likewise in the different way. Different way. So now the problem is how to estimate portfolio expected return and portfolio risk. Portfolio expected return and portfolio risk. So far you learned how to calculate for single asset expected return, risk, average return, risk. So now we are going to construct portfolio. So now you should know how to estimate portfolio expected return. Are you tired? Okay, then. Shall we discuss about our assignment? Can you present your assignment? I have tentatively I have put it because you had a 1 month leave. 1 month leave. So I supposed to do this around coordinate එන්නේ quiz එක මණ්ඩ තුනක් දාන්න විතරයි. ඔයාලට presentation කරන්න. groups වයින් දෙන්නේ තියෙන්නේ. මේක දැක්සෙත් කරුනේ. ඒක ඉවර කරලා presentation marks දෙනවා. දැන් අපිට පුළුවන් කරන්න මේ අපි යන්නේ 26 නේ. 2nd of November. නවයේ 16 කියන දෙකකින් එකක්. ඒ වල semester එක ඉවර වෙනවා මම හිතන්නේ. ඉස්තරේ ඉවරයි නේද? එහෙනම් අපි 9 කරමු. 9th November.
Kami may tingin pa.
10 කියන්නේ මේ අවශ්‍ය නැගිට බලන්න එකක් කරේ ඉලෙක්ෂන් වලට කැන්සල් වුණා නේද?
24 November end එක.
24th ඉවර වෙන ටිකෙට එන්නේ. ඒකට එනවා ඉලෙක්ෂන් එකට මට මතකයි එකක් කියලා කැන්සල් කරා. ඒක ටිකක් සතිය තියයි ගොඩක්. එනක අපි 16 කරමු for sure right? එනක prepare. මම හරිද groups මට එතකොට මම submission link එක දාන්න මට දවස් 9th වෙනකොට submit කරන්න. මෙසේජ් එකට. 16 presentation. ඉතින් දැන් මොකද කරන්නේ වැඩ කරලා presentation guidelines के upload करा most present करा you have innovative way decide to present because innovative topics I gave you last week, right? My group said about 15 minutes करते तब lecture का करें okay right portfolio expected return. Portfolio expected return is easy. Portfolio expected return we can calculate simply by weighted average expected return of the individual assets in the portfolio. If your portfolio consists of 10 assets, so then you can know weight on each asset. Suppose 3 assets portfolio, we are discussing only the two portfolio. Suppose you have 3 assets, A, B, C, 2 stocks. Suppose you have invested 40% of your wealth on stock A and 30% on stock B and another 30% on stock C. This is the weight of the portfolio. And also you have calculated expected return for the A, say 12%, expected return B 15%, expected return C say 10%. So likewise you have calculated. Now you know how to calculate expected. So portfolio expected return means weighted average expected return of the individual asset. 12% into 40, 10% into 30, 15% into 30. So that is the portfolio expected return. That is easy. If you have 20 stocks, same thing. That is portfolio expected return. So this is expected return each stock in the portfolio, the proportion of the weight of each stock in the portfolio. Before going to the risk, this is the important thing. Now suppose X and Y, same example. Suppose you are going to construct equally weighted portfolio. Equally weighted portfolio, 50-50. MLM equally weighted weighted, sometimes 60-40, 20-80, so it can be changed, right? This is an equally weighted portfolio using X and Y. So calculate portfolio expected return. Calculate portfolio expected return. Before going to the risk of the portfolio, just calculate portfolio expected return. We have already calculated expected return stock X, expected return stock Y, weights given. What is the portfolio expected return? Expected return X wagon, expected return Y wagon, weights portfolio expected return. Earlier we calculated the expected return X and Y. We are going forward with the same example with the portfolio. 3.42 here expected return X, again 50%. Y will expected return again 50%. That is the portfolio expected return. Here you go, brother. This here 50 means that is equally weighted, so that you can take 50-50. Expected return is how much?
2.34. While the 1.7.
Portfolio expected return. Yes. Excellent. This is the expected return X 4.68. This is the expected return Y 3.42 earlier we did. So now portfolio expected return 4.0. 4.0. So it's the important part. Risk of the portfolio. That is the important thing. So this is easy, no problem. That is weighted average of expected returns of the individual stock. You can calculate it now. Now is the important part, that is risk. Portfolio expected return covered. Now portfolio risk. So like earlier, portfolio risk we can calculate using this statistical methods also. This is the same formula we applied to calculate the standard deviation for individual stocks. When we are calculating individual stock standard deviation. But difference is there. If you look at the difference here, I will explain. Now here, this RPX is the portfolio forecasted return. This is portfolio forecasted return under the state of economy 1. It's deviation from the portfolio expected return into scale of that probability of happening first state of economy. So likewise, in our example, there is the first state of economy. So we have to repeat 4 times for the first state of economy. So that is the variance of the portfolio, and the square root of that is the standard deviation. So this is statistical method for calculating portfolio risk. Statistical method. The problem with this one, for the 2 asset portfolio, you can manage this statistical formula to calculate the standard deviation. But I told you that in a well-diversified portfolio, at least it should consist more than 20-30 stocks. Portfolio එකක් හොඳටම diversified එකක් වෙන්න නම් ඒකේ stocks තියෙන්න ඕන. අපි මේ කතා කරන්නේ asset දෙකක portfolio එකක් විතරයි. For the 2 asset portfolio, this is easy. You can apply, you can calculate. I will show you if you require. But anyway, for the exam, we are not applying statistically. But when the number of assets are more than 2, applying this formula, very, very complicated. Very, very complicated. So therefore, in financial management, we are not using the statistical method to calculate the portfolio risk. Possible, but very difficult. Complicated calculations are coming when the number of assets in the portfolio more than 2. So therefore, what is we are using here? We use this double summation formula, double summation approach or double summation formula. This is you can expand to any number. When the number of assets are increasing in your portfolio, you can expand weighted variance and also the covariance. So likewise, you can expand this. I will explain very briefly. So this is double summation approach. This can explain when the number of assets are increasing in the portfolio. This is you can explain. This is based on metrics like this. Now in our example, in our discussion, we have only 2 assets. So this is 2 by 2 matrix. 2 by 2 matrix. So you can see 2 columns, 2 rows. 2 columns, 2 rows. These are not relevant to the exam for your understanding, right? 2 by 2. So 2 columns, 2 rows. So how this formula is coming from this matrix? So you can see weight 1 means stock 1. Who is the second stock? 1, 2, that is the meaning. So weight 1, standard deviation 1, 1. So standard deviation 1, 1 means That is actually the variance of that stock. Standard deviation 1 mean that is variance. So therefore we are taking this one here. Weight stock X or say stock 1 twice of that into variance. Take up the maker. Then plus weight 2 and the variance of stock 2 standard deviation mean that is 6 variance. So that is y square of the weight and the variance. Plus, now look at these two. Please think about weight stock 2, 1 and covariance 2, 1. Covariance 2, 1. Method covariance 1, 2. 2, 1, 1, 2 both are same. Covariance 1, 2 give 2, 1 give they can make a so therefore you can see twice weight 1 weight 2 make it weight 2 weight 2 so therefore twice weight x into weight x into weight y covariance x and y. So this double summation formula coming with the matrix like this. Now suppose in your portfolio you have 4 stocks. You have 4 stocks. So this is the 4 by 2 matrix. So now look at what is happening. Just look at this. So you can see there is a 16 elements. There are 16 elements represented by 4 weighted variance. Four weighted variance and 6 weighted variance counted twice. Same thing, counted twice. Look, just think about that double summation formula and its endiness. මේ software වලින් එන්නේ අපි manual එකේ කරන්නේ. ඒතර මේ ඇවිල්ලා 4ක් වුණා. In your portfolio if you have 4 stocks. Just think about if your portfolio has 30 security. If you have 30 security, your matrix 880 weighted covariance. Likewise, you can expand this double summation formula for any number. There are softwares developed based on this fundamentals. But here we discuss only the 2 asset case. So therefore our formula is like this. Now look at the formula. We have only 2 asset portfolio. Weight stock X, its square, weight variance of the stock X, plus weight stock Y, its square, variance of the stock Y, plus twice weight X, weight Y, covariance. So this is the variance of the portfolio. Once you get the square root of that, standard deviation of the portfolio. You have variance, weights, covariance, all. Calculate the portfolio standard deviation. Covariance also we have calculated. Look back, there is the variance also. අපි මේ same example එකේ යන්නේ variance also there. කරලා බලන්න variance තියෙනවා. Same example. Yes. Biar kian dari biar dari kian dari dapat juga lagi sama mereka katakan ada dan biar kita katakan lagi na bisa sama kamu මේ වැඩ කරපුවා පන්තිය ගණන් හදුවා තේර දෙක කරා ටිවිස් හදුවා ටිවිස් වල ප්‍රශ්න තියෙනවා ඇවිල්ලා ආර මගේ වැටුණා මේ වැඩ කරපුවා එයාලට ඒක කිව්වා ප්ලීස් එයාලා කියන්නේ ඒක ඔයාලට කියන්නේ හරියට සෙවලි ඒකට ඒකේ රදීෂි ඕන ඉස්සරහම just the variance and the standard ASP. Then we will take some variance and continuation. The Ghana continuation that take a player एक तरह का गान दे ये गाना तक के लिए हमने portfolio then switch करने के लिए cultivation ये 22 गाना है 20 20.3 variance 20.3 it is 20.3 weight 50%. 50 it's fair our weight right plus weight x also 50 variance y 21.8 variance y 21.8 twice into weight 5 weight x 0.5 weight y 0.5 covariance was minus 10%, 10.73 minus 10.73. So this is the variance. This is the variance. consider the square root of that is the portfolio standard deviation. The standard deviation, variance and standard deviation, what are the answers? Tell me the answer. About 2.28. 2.28 portfolio standard deviation. Answer should be 2.28. 27. Right. 2.30, not 2.28. That is correct. I'm just going to discuss this 2.28 because correlation coefficient is still there to discuss. Now, just keep in your mind, we construct portfolio to get the highest return at a minimum level of risk. That is our expectation. Now, your portfolio risk, you can see 2.28. If you invested stock X only, your expected return was 4.68. Standard deviation was 4.69. Something. If you invested Y only, the expected return was 3.42. The risk was, standard deviation was, standard deviation around 4%. 4.7. Now look at, if you construct the portfolio, combining X and Y, your portfolio expected return very close to the individual stock expected return. Your portfolio risk, what happens? It has decreased to 2.28. 2.28. So there is a diversification effect now. There is a diversification advantage. I'm not going to elaborate this point further because we want to discuss correlation coefficient also. So therefore, I will stop that point. So let's go to the correlation and then we'll come back to that one again. Now, when we calculate this covariance, I told you that the problem with the covariance, you cannot identify the size of the movement. So therefore, you can calculate correlation coefficient for that. Then you can identify both the direction of the movement as well as size of the movement. Here, covariance, you can define covariance. Now you know what is covariance. Covariance you can define. Covariance is equal standard deviation I, standard deviation say X, standard deviation Y into correlation coefficient between two stock return. මේක අපි rho value එක කියලා කියනවා මේ p අකුර වගේ තමයි පාවිච්චි කරන්නේ මේ නැත්තම් CORR කියලා දාන්නත් පුළුවන්. This is correlation coefficient between X and Y stock return. Correlation coefficient අපි සිංහලෙන් කියන්නේ සහසම්බන්ධතා සංගුණය. covariance කියලා කියන්නේ සහවිචලතාව. සහවිචලතාව. correlation coefficient කියන්නේ සහසම්බන්ධතා සංගුණය. So covariance is equal standard deviation X, standard deviation Y into correlation coefficient between the X and Y returns. So then from this you can solve this formula for the correlation coefficient. So then correlation coefficient is equal covariance divided by standard deviation X, standard deviation Y. What is the difference between covariance and the correlation coefficient? As I mentioned just now also, both we use to measure the co-moments of the two stock return. By looking at the covariance, you can identify only the direction of the movement, whether they are moving to the same direction or opposite direction. But if you know the correlation coefficient, you can identify both direction as well as size of the movement. Correlation coefficient normally lie between -1, 0 to +1. Right? Correlation coefficient will lie will be during -1 to +1. So then can you have a correlation coefficient as 1.2? In between -1 to +1. If correlation coefficient is -1, we call perfectly negative correlation coefficient. Perfectly negative. So that is negative. So their movement is negative. That is the meaning. Perfectly negative. So perfectly negative means in a particular time in the economy, if X stock return increased by 1%, Y stock return is decreasing by same amount. That is the meaning. Perfectly negative. X එකකින් වැඩි වුණොත් Y 100%ින්ම අඩුයි. ඒ perfectly negative. X 10%කින් වැඩි වුණොත් Y 10%ින්ම අඩුයි. That is the meaning of perfectly negative. So there is perfectly positive. Positive one කියලා කියන්නේ this is perfectly positive. So their direction is positive, perfectly positive. So that is opposite to the perfectly negative. So when the X is increasing by 1%, Y also increasing by the same amount. Perfectly positive. These are extreme values. Perfectly negative, perfectly positive, 0 are the extreme values. 0 means there is no correlation. You cannot interpret what happens to the Y when the X is increasing because there is no correlation. None. So normally in the practice, you will get the correlation coefficient in between here to here and here to here. So if your correlation coefficient is say -68, what is the meaning of that? If your correlation coefficient is negative -0.68, how to interpret? What is the meaning of that? The direction of the movement negative. So how do you interpret 0.68 negative? How do you interpret?